Okay, execution alphas. So this is what I call the quant execution innovation cycle. And again, just talking about slippage one more time, it is what we call the hidden tax of trading. You guys working really, really hard to come up with your convictions of what you want to trade. And you all know that slippage is a real thing, and we are doing whatever we can to try and fight it. If I were to define it a little bit more quantitatively speaking, I can think about your slippage, inclusive of fees, as the expectation of market impact, meaning every dollar that I decide to trade now is going to be interacting physically with the limit order books and push the price away from you on average. Every dollar that I decide to trade later is running at the risk of missing the arrival price. Mathematically speaking, at a very high level, I can think about the estimation of market impact as a function of the intraday expectation of the volume, the volatility in the market, the bid-ask spread, the quantity that you're going to trade, although there are some researchers that don't like to use the quantity as an estimation, and we're going to cover that in both intraday manners and in a daily manner. This selection of volume, spread, volatility, and many other, if you like, execution alphas are libraries of estimations and expectations that we are building. And this is a nice, funny diagram to try to explain what I call the execution innovation cycle, which is come up with some models that try to predict microstructure trend in the market, finding a way for those models to be manifested in the algos that you're trading to try to fight slippage versus your favorite benchmark, use transaction cost analysis in post-trading in order to try to understand between the theory and practice what worked well, what didn't work well, and continuously feeding that to try to improve the models. So I'm going to be focusing mainly on spread, volume, and volatility estimations today, but you can imagine there is a feature N of those interesting libraries that we're using in different ways to time the market as we trade. Some fun observations. So there's no modeling. This is just a microstructure view of what happens from a volume prism. In this particular example, I took a year long of a recent year of BTC USDT consolidated book and tried to look at how the expectation of volume look like in the market on average. On the left-hand side graph, on the x-axis, you will see time in UTC. Y-axis looking at the cumulative volume from 0 to 100%, and each one of the lines that you see there is a 1 week average of the expected volume in the market. The immediate conclusion from this graph is that volume is pretty consistent. There's a little bit of idiosyncratic filtering here, of course, but if you're looking at the arrow bars that I draw in the middle, you can see that they're relatively small. There is some sort of an interesting consistency. On the right-hand side, this is a decomposition of the volume as percentages. So each one of those whisker plots representing the expectation of the percentage of the volume throughout the day. So if I were to sum all the averages, I will get 100%. There is an interesting effect here, which I like to call the MOX effect. The reason why I call it MOX effect is because no one told me I cannot coin an interesting phenomena. Market open, crypto explosion. So interestingly, if you're looking at APAC open, you will see a little bit of a kink of the volume there. That's probably because perps get rebalanced around midnight. APAC is opening. You can see that kink more pronounced around the UK London market open, but it is very, very significant during the US open specifically, where you can see that the volume almost double. Maybe it's a little bit hard to read, but it's about 3 to 4%, and it goes up to 7 to 8% during the US market open. So the volume has that inclination of increase. As you can imagine, volatility will follow, and we're going to see it in a moment, and there is some sort of a decline. And again, if you a careful eye will notice that if I think about perpetual rebalanced at midnight, 8 a.m. and 4 p.m. in UTC time, you will see small kinks of that volume. Why is that important? We're going to look at the expectation of market impact later, but theoretically speaking, volume is inversely proportional to your market impact, meaning that if you're trading at an area or a statistical pocket in the market that has more volume, in expectation, your market impact is going to be smaller. And hopefully that's intuitive, because if there is more volume, the information that you disseminate in the market is smaller. The hedging of your market makers providing the liquidity is going to be cheaper as well, because it's easier for them to get liquidity. So theoretically speaking, trading at statistical pockets of higher volume is intuitive. How do you do that? Using a VWAP algorithm, and we're going to discuss that in a moment. So this is a volume view. So I move to variance. This is volume, this is variance. Kind of looking very similar. Of course, volume and variance are highly correlated in nature. On the left-hand side, again, we're looking at the cumulative variance of every one of the 1 week views of 52 lines there. The immediate observation is to see that the error bars are now being wider. So again, this is volume and this is variance. And of course, volatility is volatile in nature, is a little bit harder to predict, is a bit more idiosyncratic in nature, it has a bit more variability. On the right-hand side, very, very similar patterns, but if you're looking carefully, the actual whiskers plots, or specifically the edges of the whisker around the US market open, are even wider versus volume. So again, this is volume and this is variance. So you can see that there is even more volatility. So volume itself is more volatile during US market open. Maybe come across as not a big surprise from my equities knowledge. As I was building factor models in the past, the idiosyncratic component versus the factor variance explained in US open is always much larger, and then towards the US close there is much more factor variance that can be hedged appropriately. That's usually being claimed because of the ETF creation redemption and the NAV prices getting actually being determined at the US close. Kind of interesting similar pattern here. Finally, on spreads, again, we're talking about one of the most liquid assets in the world, the BTC USDT book. So as you can see on the right-hand side, looking at the top of the book spreads in basis points, this is like 0.25, 0.35 of a basis point. The book is really, really tight. The tick size is really, really small, and it's much more flat. You can see the variability on the whisker plot around the US open again, but there is a good consistency. On the left-hand side the chart, there is volatility being decomposed into different regimes. So it should come at no surprise that when volatility is higher, the spreads is wider, and vice versa. So the purple line at the top there representing the volatility. So we got a little bit of a sense of the observations and what happens in the market. What do we do with that? We're creating our own predictions. So for about 23,000 assets versus their respective exchanges overnight, every night, with one goal in mind. At UTC midnight, I want to have a prediction for every asset of the expected volume, spread, and volatility for the next 24 hours in, say, 1 minute resolution, so that I can tell with some good confidence what is the expected volume, say, between 10 a.m. to 12 p.m. later today, as a function of the model. And this is just a representation of what I call the model pipeline. We're taking trades and quotes, we bin them in some ways, we do feature constructions. The main bulk of the innovation here is maybe the calibration. So as they're looking on a window of, say, the last 90 to 150 days, how would I come up with the exponential weighting of the different historical patterns? How am I going to do smoothing of those curves using things like adaptive splines, doing some clustering at the back end to make sure that I'm doing the adaptive splines in a way that is consistent across different statistical pockets of assets. So there is a little bit of quantitative manners there, with the hope again that every day I have those predictions available for me to use in our Talos algos to be able to time the market in all sorts of different ways. And hopefully we will get a sense of the implication of that and how we actually use it in some algorithms. It would make no sense for me to show you all sorts of fancy diagrams of how we're doing calibrations without giving you a little bit of a sense of our statistical measures and the R squared. The bottom line of this graph is that we are doing an R square here of the actual prediction versus reality in every 1 hour bin for the 1 year of data. This particular analysis is running on the top 75 spot and perp assets within our universe across 50 exchanges. Volume R square is roughly 65 to 75%. When I did the same analysis in equities, it was around 80%, so I know that the numbers make intuitive sense. Spreads are really consistent and easy to predict, so somewhere around the 80%. And volatility is maybe around the 25 to 35%. There is room for improvement. We're using some Garch models now, and we're trying to improve that a little bit further. Without going too much into the details, this is a little bit more of a sensitivity analysis, and on the right-hand side you can see the arrow bars of our prediction versus reality on the volume, spread, and volatility. But if I were to insist on one particular point that is worth mentioning is the diagram here on the right-hand side. So we are doing a recalibration every 24 hours. And you might ask yourself, what will be the implication of not doing the calibration every 24 hours? Maybe I can do it every week, maybe I can do it every month. So this correlation bar charts trying to present what will be the expected correlation between the model prediction and reality after 1 day, which is the top one, or if I were to keep my prediction consistent for 5 days and then try to look at the correlation with reality, you can see that it dropped by half. So there is a lot of justification for doing the recalibration overnight. As you can imagine, we're going to use things like Kalman filters and other things to try to incorporate real-time volume with our prediction to make it even more accurate in an intraday setting. But given that we're already in the 65-75% R square for volume, that gives me the confidence that we're doing the right thing. And some of our algorithms using that seem to be yielding some good slippage experience. Speaking about such algorithms, VWAP. So in case you are not particularly familiar with the volume-weighted average price algo, I have a simple example on the left-hand side chart. X-axis is time, Y-axis is the expected completion of the number of coins. This is a fun example of if I were to trade over 12 hours, 65 BTC. The purple line representing a nice linear line that is the time-weighted average price, meaning that you will trade in equal portions along the path of the execution. And the green line representing the volume-weighted average price execution path. They're doing nothing but weighting the quantity that I want to trade in accordance to my prediction of the volume. So the gray area graph representing the expectation of the volume, and I will weight my execution towards where there is more volume. So when there is more volume, you will see the execution line being accelerated up. On the right-hand side is just a representation of how we show it to our clients on the platform, where, given we have some predictions of spread, volume, and volatility and other things, we're providing multiple of these analytics and compare them intraday versus a daily view. So what you see here on the graphs, the interval representing what is the expectation of the bid-ask spread, for example, 0.84 basis points. What will be the expected participation rate, 26%. By the way, these are all just random numbers, so don't read into the actual numbers themselves, versus the daily view. So it gives you a little bit of a sense of saying, for example, if I were to trade during a particular period and I believe that my volatility will be twice as large compared to the daily volatility, maybe there is a different way of how I want to trade that. Maybe I want to shorten my horizon so I'm not exposed to so much volatility or the risk of missing the arrival price. And this is why we provide those statistics. I'm going to show you a little bit more interesting example with a full-fledged pre-trade using market impact models and other things in relation to that will make a little bit more sense. So that brings to conclusion a little bit of analysis in relation to spread, volume, and volatilities.